I'm now pleased to introduce our first panel. It will be Views from Leadership, the Importance of Impact Accounting in Decision-Making, Risk Management, and Compliance. The panel will be moderated by Tracy Palandjian, CEO and co-founder of Social Finance, former member of the IWA Board of Advisors, and a current member of the IFVI Board of Directors. She'll be joined by her panelists, David Blood, founding partner of Generation Investment Management, Nidhi Chadda, Chief Impact Officer at RGS and founder and CEO of Enzo Advisors, Elizabeth Rubin, Global Head of Sustainable Finance at Pure Storage, and Quyen Tran, Head of Sustainable and Impact Investing Integration Strategy at Cambridge Associates. Tracy and panel, over to you.
Come on in, there are lots of empty seats up front. You'll be more comfortable. Well, Dan, that was fabulous. It was concrete, it was rich, it was not overwhelming. I hope everyone got a chance to understand what a massive deal this is. This is truly a watershed moment, and I've had the privilege of being there at the beginning with Ronnie and with George. The fact that we're here today is not just their vision, but the grit and focus it took to get us here. And yes, Ronnie, George, I know what it's like to be called every day by Ronnie, being a co-founder of the business at Social Finance. So thank you for your vision and your perseverance. We have an exciting conversation here today with our panel. You just had a sense of what this looks like on paper, but we're gonna bring it to life. And we have an ability to hear from many different actors with very different perspective to bring this, what does it mean to quantify impacts, right, in accounting statements? What does it mean to bring externalities, whether positive or negative, into the accounting statement so that you can make better decisions? So today we're gonna hear from a range of folks. David Blood in the middle, an investor perspective coming from probably one of the most admired investment management firms in the world, but also my friend, mentor, and my other co-founder. We also have Quyen Tran in the middle next to David from Cambridge Associates, well known to many of us in this room, a trusted investment advisor to asset owners across endowments, foundations, pensions, families, and others. We have a very important company perspective at the end from Elizabeth Rubin, coming from Pure Storage, a data storage platform and technology company. And then finally, an innovative data provider in Richmond Global Sciences, RGS, and Nidhi Chadda. So thank you for being with us. So we're gonna be quick and chop, because this clock is right in front of me. So I wanna start with the first question. I'm gonna start with you, David. How do you come to this work? How do you come to this worldview of impact accounting?
So I have been working in sustainable finance for 21 years. And I hate to say this, but finance generally for 43 years.
So you have a deep appreciation.
I was there in 1933 when we started working on it.
You have a deep appreciation of the machinery that's in place.
Yes.
Quyen, how do you come to this work?
So in the investment industry, I've been working with investors to launch impact-labeled strategies across asset classes. And I'm also a professor of impact investing at Tufts University. And the team, the foundation, the IFVI, comes to my class each year to teach the students, grill them, cold call them on the methodologies.
Fantastic. Elizabeth.
Great. Elizabeth Rubin. So I came into this, I've had 25 years of corporate finance experience in the Silicon Valley in different tech companies, so huge finance background in corporate. 2019, I came to Climate Week and it illuminated that crossover that Dan was just talking about between finance and sustainability. And now finance and economics can be at the heart of global change, and that was just super inspirational. And I doubled down on my career to just do this, and here I am. I'm very excited to be here.
Nidhi.
And I'll take David's 43 years, divide by 2. I have about 20 plus years in financial services, 10 of which were in investment management. I was a portfolio manager at RBC Global Asset Management, where I co-managed small mid-cap and also recognized what was happening around the globe in ESG and impact. And that's really what led me to the journey of becoming an entrepreneur. Not only just building my advisory practice, but more recently joining RGS and helping to link data to financial implications. So we'll talk all about that. But the collaboration of those factors into what the finance and valuation is what really inspired me.
That's great. Well, Elizabeth, why don't I start with you from the company perspective? Give us a concrete example of how impact accounting has helped you make better management decisions.
Excellent. So I want to give a little bit of background about Pure Storage. So we are storage in data centers. And our mission right now isn't more clear or more important, because data centers globally are expected to double in their energy consumption over the next 2 years to reflect 4% of energy demand worldwide, 6% into the US. And so as energy is one of the largest greenhouse gas emissions, the mission isn't any more clear for us. So as John Callsgrove, our founder, actually says, is now that he goes talks to customers, they're not budgeting their data centers in dollars anymore, they're budgeting in watts. They can't get enough watts to grow their business where they want to go. Pure Storage, that is opportunity for us. 2009, we got started, and fundamentally on efficiency. Efficiency, high performance, but in efficiency, we have these little flash memory chips are high performance. They're in a little small form factor, they're driven by software, they require less energy and have a longer lifespan. And many people don't know that a lot of our data centers, a majority, are driven on 70-year-old technology. And it kind of reminds me of the financial statements from the past, right? It's time to be disrupted. And that technology requires 10x the energy, 5x the space, 5x the e-waste. And so here we are, we're number 2 in our flash storage, and we're growing market share, and we believe it's not just the business outcomes, but the sustainable impacts that we've had. And our CEO came to me in sustainable finance and said, hey, I can't measure this. It's a huge competitive advantage for me. I believe this, I can't measure it, what do I do? I had learned about the impact-weighted accounts. I'd been studying George's work and saw Rob, and I said, I know what we can do. We joined the VBA. We've piloted our first impact accounting model on their environmental impacts, and we did the whole thing, the full upstream, downstream. We actually have created environmental cost of goods sold to run alongside our financial accounting of our cost of goods sold. What does this do? Okay, what do we do with this? No, we take a look at our R&D resources and how are we allocating those to go drive down those energy demands. It also illuminated a very interesting aspect of our Evergreen One business model towards circularity. There's a significant amount of environmental potential there that we didn't know about that we're gonna go chase. But we're not really stopping there. We really want to go to the industry. We actually want to say, hey, with all of our competitors, cards on the table, all things accounted for, who really is the most sustainable? And it's through this, the IFVI work and making this public, that we can actually create that competitive marketplace. We welcome that because we believe competition drives change, and positive change is really what matters in this space. And so for us, we're really looking forward to phase 2 and changing our industry.
That's so exciting, Elizabeth, because we always think about impact measurement, impact reporting, disclosure as a risk management tool, but the idea that you can use this information to identify exciting opportunities is really exciting. Quyen, you advise a lot of clients thinking about this, maybe some are converted, some are on the fence. How do you advise them, or what do you see in this set of tools to enhance investment decision making?
So as investment managers, investment advisors, we have to know what we're invested in. That's a basic fiduciary duty. And oftentimes, the data on impact labeled strategies is incomplete in terms of impacts to the world. The data vendors out there are excellent and innovative, but they're fragmented and non-comparable, right? And so oftentimes, in the process of evaluating an investment or a fund, you analyze what we would typically remember as the 5 forces: threats to the business, power of suppliers, power of buyers, competitive rivalry. Those traditional forces are not capturing the externalities that we know today matter in terms of the durability of a company's profits, or the durability of the underlying companies within a fund that is labeled impact. And so when we add the foundation's methodology, arguably it's the sixth force. And if we don't want to go to 6 and stick at 5, we have to find a way to integrate it into the legacy 5 forces. And so when we tested, so I led a team that tested the early templates by the IWA when it was being incubated and developed at Harvard Business School. And we tested various templates: product impact, environmental impact, employment impact. It was fascinating. It forces us to think about things that we did not quantify but we knew mattered, both on the risks as well as the opportunities. So let me just bring this back to one example. Let's say we're looking at 2 companies that are comparable, they're peers. And one company, and let's say all else is equal, pretty much, but one company has a pathway, recognizes externalities and has a pathway towards addressing those externalities. For example, a food product company. Right now, the IFVI data has a lot of detail on the nutrition balance of food products. And so let's say there's 2 food products companies, beverage and food, and one recognizes that demand for its healthier choices is actually in favor because of the negative externalities from the unhealthier products being sold, the highly processed food, the sugar water, et cetera. And so this company, Company B, is reallocating its capital towards the business mix, the product mixes that are healthier. It potentially avoids lawsuits, better brand reputation, avoids the loss in demand for the less healthy foods that can lead to cancer and other diseases. When we see that happening, similar to how we see a company having a credible pathway towards decarbonizing its operations or on a path to net zero, of course we would favor the one that has more durable and resilient business model. So the investment decision's much easier to make when you can quantify that.
I love that. Nidhi, I know you have a presentation and feel free to pull it up anytime, but tell us how this sits with you as the data provider.
Yes, so Tracy, with my background, having had the luck of working as both an advisor and as an investor, and now working with an AI intelligence-based platform, it's been very interesting to see this journey. And I'd say from a corporate lens, from an advisory lens, what I'm seeing real time with companies is 3 things. When they're working on impact accounting, they are thinking about more holistic decision making, to Dan's earlier slides. I'm seeing this real time. It's not just about the SASB factors and thinking through environmental, social, and bringing in the right environmental person or the HR person to talk about it, but rather there is more of a cross-functional discussion that's happening, and it's happening in boardrooms as well. So first and foremost, that's a big change in terms of the governance of the topics. Second is UN SDG alignment. I cannot tell you how many conversations I've had on UN SDG alignment in the last 3 or 4 months. I've been on the conference circuit with family offices, endowments, pension funds. They've been interested, corporates are interested, and the way we operate in terms of thinking about impact accounting, we can actually link it back to UN SDGs. RGS provides that opportunity to do so, where we have these metrics and we link every one of those metrics back to an impact on a UN SDG, so it's all monetized and it's a standardized approach. And then the last bit, which I think is the most exciting, is what I am seeing real time right now with companies, portfolio companies at private equity firms. They are actually incorporating impact KPIs to link them to financing. So I am seeing changes in loan terms. I am seeing differences in covenants. I am seeing very creative financing mechanisms being crafted around impact KPIs. So this is all early innings, but definitely a lot of progress. And the investor side, of course, the standardization is very key. Everyone's very excited to see that. Just being with the pension funds and endowments more recently, there's a lot of talk of the wealth transfer. I am seeing it live. I'm having those conversations, and they love the standardization and more data being available.
That's exciting. David, from where you sit and having listened to Quyen and Nidhi, how are you actually making different investment decisions?
Well, I think we need to make different investment decisions, and the truth is we're not currently doing it. And I actually want to go back to actually a little bit further up in history to sort of the mid-60s, early 70s around portfolio management and bring it into why this is so important to us. So my dad was a portfolio manager at Ford Motor Company in the 60s and 70s. And the way he built portfolios was basically to take no risk. He would invest in the Nifty 50, couldn't possibly invest in a company outside the United States, so it was just the Nifty 50. He would invest in AAA government bonds, AAA corporate bonds, and if he felt really, really aggressive, he'd buy AA corporate bonds. So that was how he built portfolios. And it wasn't until people like Ronnie Cohen said, well, what if you got paid to take risk? And the whole industry began to change. And there were academics who were beginning to talk about it, and the whole risk and return metrics was developed. And so for my career, that's how we always thought about finance. It was risk and return. But it wasn't always that way. And the reason why I say that is we need to fundamentally change our way of allocating capital to have risk, return, and impact. And the reason why this is so urgent is going back to your Sustainable Development Goals. Right now, we will miss every single one of the 17 Sustainable Development Goals. A pensioner living in a 3 degrees C warmer world with degraded ecosystems and great inequality will not enjoy the fruits of their retirement. So it's our fiduciary duty as capital allocators to think differently. And we know very well that our capital allocation is flawed. We're not internalizing externalities. We need to understand the impact that we're deploying capital against or into. And so the reason why this is so important is we as capital allocators need to evolve how we think about capital allocation. We need this technology. We need these processes to give us better tools to allocate capital going forward.
David, I love that. And this is Ronnie's, three-dimensional, right? Like the three axes: risk, return, and impact. And you've written so much about it, so I'm going to have a follow-on question to you, David. Do you think that the markets need to be longer term in their time horizon in order to realize the fruits of this three-dimensional picture?
Well, we think long-term investing is best practice, full stop. And it is currently not. It's very short-term oriented. But I think the risk, return, and impact framework works for all time frames. It's not just only long-term. It's going to be important that we think about it continuously.
Yeah.
It's actually a really good time to share in the celebration today, as Sir Ronald Cohen talked about in the very beginning. We actually are having a very big day of celebration here at RGS because we have launched the first Global Impact Leaders list. And if we can actually also pull up the slide 1, I'll talk a little bit about this list. So a really important day for us because this is the first publicly available list for companies, 110 global companies based off of impact accounting. We looked at monetized impact across the globe, and we have looked at 10 companies across 11 sectors to identify what those impact leaders could be. Absolutely, please take out your phones. It's a great table, a great chart. Now, what we've done is, not only did we come up with a list, we went further. We created an RGS Impacts Leaders portfolio. And we said, let's use our data and identify if we were to invest in these companies, 110 companies, equal weighted basis, on a global scale, if we looked at it from a 3-year, 5-year, and a since inception period, what would the results look like? Now, don't roll your eyes at me because we're doing a back test here. There's a lot more to this back test. 3-year outperformance, 5-year outperformance since inception. We are looking at a portfolio that not only outperformed, has lower volatility, it is diversified from a sector standpoint. So we did not get the benefit of the Magnificent Seven. However, we selected companies in other sectors that were the right names. For my portfolio manager friends in the room, Brinson Attribution showcased that exactly. Second, we saw no significant style or factor biases at all. So there was nothing really driving it that we said there was a tilt per se in the actual numbers. Portfolio was conservative. We saw nice downside capture numbers. And then it's income generating. In today's rate cut environment, that could be pretty exciting. So this is just data. And what has really got us very excited about it is the fact that we were able to do this just by pulling together the list of the top impact leaders, which is now actually available online. So if you go to slide 2 for a second. And I'm at a Harvard Business School event. I'm an HBS alum, but there's no HBS event that can happen if we don't have a cold call. So can I cold call Professor Serafim to the front of the room? Okay. And can you please bring your cell phone? Oh. And I'm gonna. No, you're gonna do it. Okay. You're gonna do it. Okay. This is fun, guys. I used to remember the HBS days. So, Professor, can you scan in the code? And can I ask everybody to take their cell phones out?
Okay. Good thing I'm here.
Scan in their codes. And what you should get on your phones is an impact leaders list. You're going to see the top 15, and if you enter in your email addresses, you'll see the remainder of the names. Hopefully those codes are working. They're working? Yeah. All right, good. So that's it all. Yeah, you can say it. Thank you for participating. Thank you for participating, professors. But that's what we wanted to share with you today. It's just a really exciting time to be able to have this list of companies in a standardized way and have a starting point for conversations with corporations, with investors, public investors, and then start the dialogue. So thank you all for participating in our little exercise here.
This is great. So that's a provocative chart. You're seeing alpha in 1 year, 3 year, 5 year time periods. So why is it so hard to convince more people to this space? I mean, what advice would you give folks in the room to get their colleagues, get in the sector, in their company to get involved? Quyen?
So looking at that back testing, now if the methodology is based on a repeatable, transparent, and auditable method, which I'm looking at Rob here and Dan, they're nodding, yes. The methodology is in fact transparent, repeatable, auditable, and scalable, then it is more convincing. I'm going to look that up and see if I can invest in it, but that convinces clients, and they need enduring, relatively stable exposures, not a wild ride. And so if it's based on such methodology in determining what qualifies as impact, then that's compelling.
I think one of the big challenges here is that people still do not believe that sustainability or impact is part of your fiduciary duty. And we need to really address that. Now, it's clear that sustainability is very relevant, but not everybody understands the role of impact in portfolios. And so we actually did some work around the legal framework for impact. And what we found actually is that it is absolutely within your fiduciary duty to understand the impact of your capital allocation. But more importantly, in many instances, particularly as relates to climate change, it is your fiduciary duty to understand and incorporate impact into your capital allocation.
Absolutely, especially with evidence like
Exactly.
this.
Exactly.
You would not be fulfilling your fiduciary
Exactly.
duty unless you consider these non-financial factors that will translate into financial
Exactly.
performance. And what I like to say, especially to the philanthropic asset owners, endowments, foundations, etc., you have already taken the tax deduction. It is a massive privilege. In fact, this money is dedicated toward achieving social and environmental impact. It would not be, you would not be a fiduciary unless you were taking all the actions and using all the tools available to you to actually maximize the impact of all the assets that you own. So completely, David.
And Tracy,
Nidhi?
if I can add one more point, there's still unfortunately a big misnomer in terms of definitions around impact and impact investing, responsible investing, ESG factors, risk-adjusted returns, and I'm having conversations constantly with folks about this. That confusion is still there, and the onus is really on all of us in this room to collaborate and to help educate. I think we're still at the point where education is something we're still in early innings of, talking to folks, particularly with the wealth transfer of what's going on. For example, I was in several panels where folks said, if you're investing with impact, you're not making financial returns. Well, you know what, we've seen many cases time and time again of that being the situation, private and public markets. And I'm hoping that we have meetings like this and more collaboration so we can educate folks. And especially when we see that link to the impact, from impact KPIs to financing terms, this is real. It's happening, and people will start to see and be able to look at that standardization and approach.
Yeah. Elizabeth, I want to make sure that we hear enough from the company's perspective because this is such an important one.
That's great. Yeah, thank you. So, so there's this emerging role of an ESG controller. It's actually grown, this role has grown 3 to 5x just even in the past year. And I'm part of an ESG controller consortium. And I do think right now everybody's just thinking about risk. Regulation. Oh my gosh, there's regulation. What are we going to do? And we're all spending enormous amounts of time and dollars on consultants to go do that. And there's a feeling that this is just an extra burden to it. But really, this is 1/5 of my job scope, and I have a contractor who's running this model. The data's there. It's these value factors conjoined with our data is what puts it on the table and makes a decision useful. And the companies that are gonna win are the ones that the investors see because they're the most sustainable. So it's like there's this hidden opportunity in there for all of us to start realizing that actually these are going to be the successful businesses of the future. And if you toil all of your time on risk, you're going to miss it. And it's going to be those companies that realize that this is opportunity, delivering on business objectives and also sustainable value on a very scarce resource, water, greenhouse gas, climate change, all these things. If you're a company that can do both, you are winning, and the investors are going to recognize you, and you're going to gap away from your competitors. And I feel like that's the big thing. And everybody's like, oh, it's so much work to go do it. But this is why this is so big for us, is that this is out there now. Like, we joined the Value Balancing Alliance to get access to this, but now this is publicly available. You've now leveled the playing field. Everybody can go do this now. Everybody can find their opportunity. We can look at your business model and really see if it's sustainable. And investors are going to start seeing that. And I think the final thing I would say is you need executives to understand this. I was wildly proud that our CEO came to me after he'd gone to Davos, and he's like, I got to account for this. There has to be this cost accounting approach. And I'm like, yes. But you have to have those executives actually get it. And that's the seed of change. And I think corporates need that, and we're so mired in regulation right now. I mean, the EU CSRD 1100 metrics, like, most of my job is towards that, but this is the value of where we're going. So I hope more investors start raising this to executives.
I love that. Gap away from your competitors. That's a memorable line.
Competition.
I'm going to ask all our panelists to close with a call to action. Elizabeth, you kind of started already, so why don't we just go down this way?
Call to action is put this on the radar of executives and corporates to start asking about it. We have the data. Everybody's going to throw up barriers. The data's there. The value factors are there. A plus B, you're going to get C. So I think it's not that hard, and we don't have to make it complicated to start change, and you have to start somewhere. So I'd like all of the investors to do that.
Jump on this opportunity to be part of something very disruptive. It's been incubating for 5+ years, so there's already proven success. But this is really an opportunity. It is still not mainstream, but you can be a great part of that. And it doesn't have to be perfect. You learn a heck of a lot from imperfection.
Finance evolves, finance changes, and this is what we need to do to accomplish all that we care about in terms of people, planet, and nature.
And I'd like to close with the line I've been using more recently, let the data guide you. It really is about the credibility of the data, the information, the interconnectivity of the data, as the professor had talked about earlier, and having those conversations with boardrooms and with investment teams about linking these E, S, and G factors. More holistic thinking about how all this is coming together. I'm seeing those conversations on the impact side, so we just need to keep pushing the envelope there.
Well, I hope that you've enjoyed this panel as much as I. It's not just about making better decisions, but how important this movement is in ushering a new economic paradigm, or what Ronnie calls the impact economy. So please join me in thanking our wonderful panelists. Thank you.
Big thank you, Tracy and panelists, for the lively discussion about what it's going to take to move us to risk, return, and impact. Now, while our next speaker unfortunately could not be here in person today, we're so grateful that he's pre-recorded a message for today's event. Gordon Brown is the former Prime Minister of the United Kingdom and a longtime supporter of GSG Impact and the Impact Task Forces under the UK presidency. Let's hear his message.
I'm delighted to speak at the opening session of this great historic event, for I can only marvel at the remarkable achievement of pioneers who today are bringing together over 100,000 environmental value factors that will now measure the impact of companies on our planet, measuring air pollution, greenhouse emissions, land use, waste, water consumption, and water pollution, and so revolutionize how we account for sustainability. So first, I want to congratulate Sir Ronald Cohen and the International Foundation for Valuing Impacts, established in association with the Impact Task Force set up by the G7, who are during this UN Climate Week and in partnership with the Value Balancing Alliance, breaking new ground. In the words of my good friend Nobel Prize winner Mike Spence, you can't get anywhere on climate without an adequate measurement system. Companies will now be able to measure risk, return, and results, that is, social and environmental impacts. And so we're in a position to make huge progress on measuring climate change. You know, just as after the great crash of 1929, we had to regularize company reporting by standardizing company accounts, so too in 2024 with social impact accounting, we're now standardizing the way we measure environmental impact. We can compare now the impact of individual companies to show where investment will yield greater sustainability or less. Soon investors, consumers, employees, and all stakeholders will press for the new social impact account to sit side by side with the company's old profit and loss account. This open source measurement, which is globally applicable, will expose greenwashing and bring an end to it. For the first time, investors who want to, and we want to, channel trillions into ESG investments will be able to rely on robust data to measure and compare in monetary terms the impacts created by their actual and potential investment. To all those from Sir Ronald Cohen outwards involved from this